Welcome to the deep dive. Today, we're really getting into the nuts and bolts of the VA home loan process.
Yeah, specifically how lenders handle things on their end.
Exactly. We've got the VA Lender's Handbook here, Chapter 5, mostly processing and submitting loans. And we're pulling in some key bits from Chapter 4 on credit underwriting, too.
Right. And the mission really is to map out those steps lenders take. Understanding their side of it can, give you a real advantage when you're going through the process yourself.
Makes it less of a black box, hopefully.
Definitely.
And just to be clear, this isn't guesswork. We're pulling directly from those handbook excerpts.
Straight from the source.
Okay, so where do lenders typically kick things off? Seems like there's one document that comes first.
That's right. It's almost always the Certificate of Eligibility, the COE.
Ah, yes.
Before they do much else, they need to confirm the veteran or surviving spouse is actually eligible for the benefit.
And it tells them the entitlement amount, too.
Exactly. How much entitlement they have available.
So how do they get that? Is it complicated?
Not usually for them. Lenders have access to the VA's online system, WebLGY. It's pretty streamlined.
Okay.
They can pull it up pretty quickly there. And, veterans can also apply for their COE directly on va.gov.
Right, I've seen that option. So if the veteran gets it themselves.
Yeah, that works too. The lender can still access that information in WebLGY, usually just needs the veteran's social security number. It's all linked up.
Makes sense. So online access is key there.
Definitely speeds things up.
Yeah.
It's worth mentioning, though, for interest rate reduction refinancing loans, IRRLs, they generally don't need the COE first.
Oh, okay. So for those streamlines, that step skipped.
Typically, yeah. It simplifies that specific refinance process.
Good to know. Now, you mentioned something, or rather the handbook mentioned something specific about active duty folks with pending disability claims.
Ah, yes. That's a relatively newer and important update.
What's the deal there?
If an active duty service member says, hey, I have a pre-discharge disability claim being reviewed, the lender has to jump on that early. They need to complete and submit a specific form, VA form, 268937, verification of VA benefits, and they need to do it early in the process.
Why early?
It's to make sure any potential impact from that claim on their eligibility or entitlement amount is factored in right from the get-go. No surprises later.
Got it. So COE first, usually, unless it's an IRRLL.
Yep.
And for active duty with those pending claims, get that VA form 268937 in ASAP.
You got it. That nails down the initial steps.
Okay, so once those are out of the way, what's the usual order of operations for the lender? Is it like a strict checklist?
Actually, that's one of the interesting things. The handbook says once the COE is handled, a lot of the other processing stuff can happen in, well, pretty much any order that works for the lender.
Really? So some flexibility there.
Yeah, as long as everything gets done before the loan closes. The sequence for things like the appraisal or credit check isn't rigidly defined.
That must help lenders manage their workflow.
I'd imagine so. But the handbook does recommend getting certain things rolling early, even if the order's flexible.
Okay, like what? What are the smart early moves?
Well, to avoid delays down the line, they suggest requesting the VA appraisal, or for an IRRL, the case assignment in WebLGY, sooner rather than later.
Get the valuation process started. Makes sense.
Exactly. Also, initiating the CAVRS check.
Remind us what CAIVRS is again.
Sure. It's the Credit Alert Verification Report System. Basically, it checks if the borrower has any defaulted federal debt. You want to know about that early.
Oh, right. A potential showstopper if there's an issue there.
Precisely. And then also requesting the credit report and any needed verifications like income or assets. Chapter 4 has all the specifics on what needs verifying.
So get the appraisal going, check CAEVRS, pull the credit, sensible things to do early.
Absolutely. Knocking those out helps prevent logjams later.
Okay. Beyond those early steps, what are some non-negotiables during processing, things that absolutely have to happen?
Well, a huge one is occupancy. The lender must ensure the veteran meets VA's occupancy requirements.
Meaning they intend to live in the house?
Exactly, as their primary residence. Chapter 3 covers the details, but the loan can't close as a VA loan unless that's confirmed. It's fundamental to the program's purpose.
Gotcha. No investment properties using the VA loan benefit.
Correct. And then, of course, there's the whole underwriting process.
Right. Analyzing the borrower's financial picture.
Yeah, a deep dive into their credit and finances. Lenders use VA Form 266393, the loan analysis form, for this.
The loan analysis?
Yep, and they follow all the detailed guidelines from Chapter 4. That form kind of standardizes how they look at the numbers.
So what goes into that analysis?
They're comparing information from everywhere: the application, the credit report, income docs, asset statements. They look at dependents, credit patterns, job stability, monthly debts.
And they have to make sure it all aligns.
They do. They have to resolve any discrepancies they find between different documents. It's about building a solid case that the veteran is a good credit risk.
Thorough. Okay, what about that counseling requirement for active duty members? You mentioned that earlier.
Yes, that's another key step, specifically for active duty borrowers. Early on, they have to receive counseling.
What kind of counseling?
It uses VA Form 260592, the counseling checklist for military homebuyers. It covers budgeting, the responsibilities of the homeownership, things like that.
And who signs off on that?
Both the veteran and the lender representative have to sign it, confirming the counseling happened. Needs to be done early in the transaction.
Okay, another early checkpoint for active duty. Now, the handbook talks about 2 different ways loans can be processed. Prior approval versus automatic. What's the difference there?
It really comes down to the lender's authority level, granted by the VA.
How so?
Lenders with automatic authority can basically process and close most loans without needing the VA to review and approve each specific loan file beforehand. They have more autonomy.
Okay, so they can move faster.
Generally, yes. Prior approval, on the other hand, means exactly what it sounds like. The VA has to review and give the thumbs up on the loan before it can close.
So when is prior approval actually needed? It's not for every loan.
No, not for most loans processed by experienced VA lenders. Prior approval is required mainly if the lender doesn't have automatic authority.
Ah, okay.
The VA strongly encourages those lenders to partner with an automatic lender, like a sponsor. If they don't, almost all their loans need prior approval, except maybe non-delinquent IRRLs.
Any other triggers for prior approval?
Yes. If the COE itself flags that VA Form 268937, that verification form for active duty with disability claims is needed before closing, that usually means prior approval.
Write that form again.
Also, sometimes even a lender with automatic authority might choose to send a complex loan for prior approval if they've hit roadblocks and consulted with the VA.
So, for tricky cases.
Exactly. And one more big one, IRRLs that are refinancing a loan that's already 30 days or more past due. Those need prior approval too.
Okay, that makes sense. So if a loan does need prior approval, what's the process? What does the lender do?
They have to package up the entire loan file and upload it to WebLGY for the VA to review. Correct. If the VA approves it, they issue what's called a certificate of commitment back to the lender.
A commitment to guarantee the loan?
Essentially, yes, but it often comes with conditions. The lender absolutely has to make sure all conditions listed on that certificate are met before closing. Then, after closing, they upload the final closing package to WebLGY to get the actual loan guarantee certificate.
Got it. Upload, get commitment, meet conditions, close, upload again. Sounds like a few steps.
It is for prior approval cases.
No, what about submitting documents for regular, automatically processed loans? Does the lender send the whole file to the VA every time?
Generally, no. That's a key point. For most automatic loans, the lender doesn't routinely submit the origination documents to the VA.
Oh, okay.
They only usually send documents if it's a prior approval loan, like we just discussed, or if the VA specifically requests the file for what's called a full file loan review, or FFLR.
We'll definitely circle back to FFLR, but for now, the lender usually just keeps the file.
That's right. Appendix B in the handbook details when and how docs need to be submitted for those specific cases. But otherwise, the lender holds the file.
Good to know.
But they absolutely need to use the correct VA loan identification number, the LIN, on everything. That's assigned early on and tracks the loan in VA systems.
Right, that unique identifier.
And sometimes, depending on the situation, a VA-approved credit underwriter might need to sign off on certain key documents in the file.
Okay, now back to those prior approval loans. They get the certificate of commitment. What if something changes between getting that commitment and the actual closing day, like the interest rate shifts?
Great question. The handbook addresses that. Significant changes might require going back to the VA for approval again.
As such.
For instance, if the final loan amount is higher than what was on the commitment. Unless that increase is totally offset by a bigger down payment from the veteran and the monthly payment doesn't go up.
Okay. So if the payment stays the same, it might be okay.
Right. But if the payment would increase due to the higher loan amount, VA approval is needed. Same goes for the interest rate. If the final rate is more than 0.25%, 0.25% higher than what was indicated on the commitment, that also needs a nod from the VA.
So big changes need a second look. You also mentioned conditional certificates of commitment. What kind of conditions are typical?
Yeah, these are common. It means the VA issues the commitment, but with specific strings attached that must be cleared before closing.
Examples.
A classic one is for an active duty service member who hasn't separated yet. The commitment might be conditioned on getting certification that they're still on active duty as of the closing date, usually handled with VA Form 26-1820 at closing.
Makes sense. Confirming their status is still valid. Any others?
Let's see. If an attorney, in fact, is signing for the veteran using a power of attorney,
Okay.
the condition might be proof that the veteran was alive and, if applicable, not MIA on the date the documents were signed.
Wow, okay. Important detail.
Definitely. Another one is if the veteran needs to sell their current VA-financed home to get their entitlement back for the new loan.
Right, restoring entitlement.
The commitment will be conditioned on restoration of entitlement. The lender then has to provide proof the old house sold and the prior loan is paid off or assumed before the new loan guarantee is finalized.
So documenting those conditions are met is critical.
Absolutely crucial. That proof goes in the closing package. Missing it would definitely cause problems getting the final guarantee.
Okay, so the loan closes, everything's signed. How does the lender report this to the VA and get that final loan guarantee certificate, especially for automatic loans?
There are timelines. Generally, lenders have 60 calendar days from the closing date to report it to the VA. This applies to both prior approval and automatic loans.
60 days. What if they miss the deadline?
If they're late, they need to provide a written explanation, signed by an officer, explaining why, and certifying the loan isn't delinquent and still meets all VA requirements. So, timely reporting is pushed pretty hard.
Okay. And the process? How do they report?
For prior approval loans, we mentioned they upload the full closing package in PDF to WebLGY.
Right.
For automatically closed loans, it's usually simpler. They typically get the loan guarantee certificate, the LGC, electronically, right through WebLGY.
So it's often automated for automatic loans?
Mostly, yes. But there are exceptions where it might not issue automatically.
Like when?
Well, prior approval loans, obviously. Also, joint loans where two veterans are splitting their entitlement, things like that.
So if the electronic LGC doesn't pop out automatically?
Then the lender has to request a manual LGC. They upload a specific package of documents, again following the stacking order in Appendix B, to WebLGY for the VA to review and issue the LGC manually.
Okay, so backup plan if the automated system flags something. Now let's talk about that full file loan review, the FFLR you mentioned. What's that all about?
Right, the FFLR. It's basically VA's quality control, oversight, and audit function.
So pick loans at random.
Essentially, yes. They select a certain number of closed loans to review the entire lender's file, soup to nuts, just to ensure the lender followed all the rules and guidelines.
How does the lender know they've been picked?
They get notified either right away in WebLGY when they report the loan or through a written notice from the VA.
What do they have to do?
They have 15 calendar days from notification to upload the complete loan file into WebLGY.
15 days, that's pretty quick.
It is. And they have to stack the documents in the precise order specified in Appendix B. The order can actually differ depending on the type of FFLR.
Attention to detail needed there.
Very much so. Plus, besides the regular docs, they also have to upload the UAD Uniform Loan Application Dataset and the UCD Uniform Closing Dataset as separate XML files.
More data for VA's analysis.
Exactly. Standardized data helps them spot trends and manage risk.
What if the VA finds problems during the FFLR?
They'll issue a deficiency letter. The lender then gets 30 calendar days to respond, provide clarification, or submit missing documents to fix the issues.
And if they don't comply?
Failure to respond adequately or on time can have serious consequences, potentially even impacting the lender's automatic authority status. So lenders take FFLRs very seriously.
Right, you don't want to mess that up. Okay, shifting gears slightly. Loan assumptions. The handbook touches on these too. What's the basic concept?
Loan assumption is just transferring an existing VA loan and its terms from the current owner to a new buyer.
So someone else takes over the payments and the loan?
Pretty much, yeah. The handbook notes that some loan servicers have automatic authority to process these, while others don't.
Does the VA need to approve an assumption?
Generally, yes, especially for loans originated after March 1st, 1988. There's a requirement for prior approval of the transfer.
Who gives that approval?
If the loan servicer has automatic authority for assumptions, they can often approve it. If not, the prospective buyer's credit package has to be sent directly to the VA for them to underwrite and approve.
So the new buyer has to qualify?
Absolutely. They need to be deemed creditworthy based on VA standards, back to Chapter 4 again, and they have to formally agree to assume all the loan obligations.
Makes sense. Is there a funding fee?
Yes, usually there's a funding fee for an assumption, similar to an origination.
What if the VA or the servicer denies the assumption?
There's an appeal process directly with the VA, and sometimes special approval might be possible. Also, the deed transferring the property needs to include specific VA-approved language about the assumption.
Got it. Now, you mentioned something called substitution of entitlement, SOE. How does that fit in?
SOE is a specific kind of assumption. It's when the person assuming the loan is themselves an eligible veteran.
Okay, a vet taking over another vet's loan.
Exactly. And if they have enough of their own VA entitlement available, they can substitute it for the original borrower's entitlement that was used on that loan.
And the benefit of that is?
The original veteran gets their entitlement restored. They can then go out and use their VA loan benefit again for another home purchase.
Oh, wow. That's huge.
It really can be. The assuming vet has to meet the credit standards, have enough entitlement to substitute, and intend to occupy the property, of course.
That's a really valuable feature. Okay, so we've walked through all these processing steps from Chapter 5, but we keep mentioning Chapter 4, credit underwriting. How do they really connect?
They're intrinsically linked. Chapter 5 describes how the procedures lenders use to gather and check all the information. Chapter 4 explains the why and the what, the standards for analyzing that information to make a sound credit decision.
So Chapter 5 is gathering the puzzle pieces.
And Chapter 4 tells you how to put the puzzle together and what the final picture should look like. For example, Chapter 5 talks about getting income verification. Chapter 4 details how to analyze different types of income, military pay, self-employment, rental income, etc., and what documentation is needed for each.
Okay.
Same for debts. Chapter 5 is about identifying them. Chapter 4 is about analyzing them, considering things like non-purchasing spouses in community property estates, student loans, how to view credit history patterns versus isolated blips.
Right. Chapter 4 gets into the weeds of the analysis.
Exactly. It talks about using automated underwriting systems, AUS, calculating residual income using that loan analysis form, VA Form 266393.
Residual income, that's the money left over after major expenses.
Precisely. Chapter 4 details how to calculate it based on family size, loan amount, region. The ultimate goal of all that underwriting outlined in Chapter 4 is to determine if the veteran is a satisfactory credit risk with enough stable income to handle the loan payment and other obligations.
So the processing steps in Chapter 5 are all in service of making that underwriting decision based on Chapter 4's rules.
You nailed it. The procedures ensure the lender does the due diligence needed to meet those VA underwriting standards, protecting both the veteran and the VA program itself.
Well, this has certainly been illuminating, really peeling back the layers on what lenders do for a VA loan straight from their own handbook.
Yeah, it's quite a process, isn't it? From getting that initial COE, navigating the approval paths, the meticulous documentation, dealing with conditions, reporting.
It definitely underscores the importance of thoroughness and following VA guidelines precisely.
There, hopefully, for you listening, seeing these steps laid out demystifies the process a bit. Knowing what the lender is working on behind the scenes can make the whole journey feel more manageable.
Absolutely. It highlights the checks and balances built into the system for veterans. So maybe a final thought to leave everyone with. How do all these detailed procedures contribute to the bigger picture of successful, sustainable home ownership for veterans?
That's a great question. It forces a thorough look before the commitment is made.
And perhaps, what part of this lender-side process is most crucial for a potential borrower to understand before they even apply? Something to think about. Definitely worth checking out VA.gov and talking to experienced VA lenders.
Agreed. Knowledge is power in this process.
Thanks for joining us for this deep dive.